Imagine a time before money existed. Picture a world where coins and paper bills were not yet invented, and digital transactions were a distant dream. How would people trade goods and services? How did they manage to get what they needed to survive and thrive? In the past, people used a system called bartering. This was a method where goods and services were exchanged directly without the use of money. Bartering meant directly exchanging one good for another. It was a straightforward system, but it had its complexities. For example, a farmer with extra wheat could trade it with a shoemaker for a new pair of shoes. This direct exchange was simple and effective in small communities. This system worked well for small communities with limited needs. Everyone knew each other, and the range of goods and services was manageable. However, bartering had its problems. It wasn't always easy to find someone who had what you needed and who also wanted what you had. What if the shoemaker didn't need wheat? The farmer would have to find someone else who needed wheat and had something the shoemaker wanted. What if the farmer wanted something else? The process could become very complicated and time-consuming. Finding someone with what you needed and who also wanted what you had was difficult. This double coincidence of wants was a major hurdle in the barter system. This lack of a common medium of exchange made trade complicated and inefficient. Bartering limited economic growth and made it hard for communities to expand their trade networks. People had to rely on coincidence and limited options. The inefficiencies of bartering eventually led to the development of money, which revolutionized trade and commerce. The need for a more efficient system led to the invention of money. In ancient times, people faced significant challenges when bartering goods. The direct exchange of items often resulted in unequal trades and complicated negotiations. Money solved the problems of bartering. It provided a standardized value for goods and services, making transactions smoother and more predictable. It acted as a common medium of exchange. This common medium allowed people to trade more freely and efficiently, without the need to find someone who wanted exactly what they had to offer. Now the farmer could sell the wheat for money. This money could then be used to purchase other necessities or luxuries, facilitating a more dynamic and interconnected economy. The farmer could then use that money to buy shoes or anything else. This flexibility was revolutionary, allowing for the specialization of labor and the growth of markets. Money needed to be accepted by everyone in the community to work. This acceptance was crucial for the system to function effectively, ensuring that everyone could participate in the economy. This required trust and a shared understanding of its value. Communities had to agree on what constituted money and its worth, fostering a sense of unity and cooperation. Early forms of money were often valuable objects like shells, beads, or salt. These items were chosen for their rarity and desirability, laying the foundation for the complex monetary systems we have today. Throughout history, money has taken many forms. Different cultures used different materials. Cowrie shells were used as currency in some parts of Africa and Asia. Native Americans used wampum beads. The ancient Romans used salt. Over time, metals like gold and silver became the preferred form of money. They were durable, divisible, and rare. This gave them inherent value. Governments standardized coins and paper money. This made trade and economic activities more organized. Section 4. The evolution of money, paper, plastic, and beyond. The invention of paper money in China revolutionized finance. Before this, people relied heavily on cumbersome metal coins, which were not only heavy but also inconvenient for large transactions. The introduction of paper money made it possible to carry large sums with ease, transforming the way trade and commerce were conducted. It was lighter and easier to carry than heavy coins. This innovation significantly boosted economic activities, as merchants and traders could now move their wealth more freely and securely. Banks emerged as institutions that managed and regulated money. They played a crucial role in the economy by providing a safe place to store money and by offering loans to individuals and businesses, which in turn spurred economic growth. They provided credit, facilitated payments, and fueled economic growth. The ability to borrow money allowed businesses to expand and innovate, leading to the development of new industries and job creation. In the 20th century, credit cards and electronic payments gained popularity. These new forms of payment made transactions even more convenient, reducing the need for physical cash and enabling instant payments across long distances. The digital revolution brought about cryptocurrencies like Bitcoin. These digital currencies offered a new way to conduct transactions free from the control of traditional financial institutions. These digital forms of money operate independently of central banks. They use blockchain technology to ensure security and transparency, making them an attractive option for those seeking an alternative to conventional banking. They represent a new frontier in the evolution of money. As technology continues to advance, the ways in which we use and think about money will undoubtedly continue to evolve, opening up new possibilities for the future of finance. Section 5. The future of money, a digital world. Money is constantly evolving. As technology advances, the future of money will likely be more digital, decentralized, and interconnected. We can expect to see new forms of money and payment systems. Despite these changes, the fundamental role of money will remain the same. Money will continue to facilitate trade, represent value, and shape the global economy. Understanding the history and evolution of money is essential for navigating the complexities of our financial world.